Hi, this is Keith. I'm going to be using the OptionStrat tool today. Using it in response to a question that was posed as it's coming from somebody who's got a position open, an options position. They're monitoring that, looking at their P&L, and they've questioned, what are the factors that are causing that P&L to go up and down, right? And I assume that they're watching the price move, the underlying price, and they're watching, time pass, as they're looking at this position. And from what I've gathered from the question is they're not quite clear as to what's the influence of those things, right? Price and time, interacting with that P&L. And I guess they're also thinking, well, what are the other factors, right? What other things are influencing that price? Because it didn't seem to correlate, I guess, to what they're expecting the price to be potentially. And the tool that's going to answer that for us, today it's OptionStrat, and this is a tool that I don't really use this. I only use just the free version, so it has just directly through their public website without even having to log in. There's just a massive amount of capability here, and there are other tools that do this exact same thing, and some of them, if you're using a more advanced broker that has a more advanced platform for trading, may have all of this stuff built in. Mine doesn't, but I have other services that I use that provide kind of this same sort of tool set. So it's not what I use, but certainly when I get a question like this, then I would direct them to this website because they don't need to purchase anything, right? It's free, and certainly for someone not familiar with modeling a trade in this manner, this is a really great tool for them to use. So I don't even know what the paid features, what you get with it. I've never actually. I think I did start a trial, but I never actually used it. So this isn't really a recommendation of this tool. I'm just recommending it in this particular situation, and I'm going to use it again for my own purposes as well as a demonstration tool here. So you can see it's quite advanced. It supports all different kinds of spread types, and it has some educational stuff here as well. Again, all free to access without any sort of paid subscription. So we're just going to model a bull put spread. And I'm also not going to explain how the tool works. I'm not going to explain what a risk graph is. So if you're not sure how to actually interpret this diagram that's presented here, or if you want to know how to use this particular tool, I mean, I'm sure there's tutorials. There's probably other online. Just do a Google search. You can find that information. This one was a little bit of difficult for me to kind of learn to use initially, just because it wasn't as intuitive. You need to know kind of where to click to sort of find things. But with some creative Googling, I was able to kind of figure out how it all worked and everything. Once you know how to use it, it's a really easy to use platform. So I like it. I love the way it presents the information. It's just visually, it's very, very appealing. So what is this tool going to do for us? It's going to allow us to really analyze kind of the risk profile of this particular trade. And I've picked bull put spread as just, this is a directional credit spread. And it's picked SPX, which is probably just the last symbol that I was looking at on this platform. And it's pre-filled some trade here. So let's just assume this is the trade. This isn't my particular trade or anything. It's just some default, probably some kind of common recommendation or something that's common for bull put spreads. About 28 days to expiration, short strike right at the money, and long strike about $25 away. So what are the factors that are going to influence our P&L? And most people should be familiar with this diagram, right? And we can see that there's one dimension on this diagram, right? The price of the underlying, right? The other dimension is our P&L. So according to this, really the only thing influencing our P&L is the price of the S&P 500 index, right? That's our underlying in this case. And that is correct in this case because we are at expiration, and that's a very important distinction here, right? So we've plotted this diagram at expiration. And so everything we see on here, the way the chart is plotted, everything really from our probability of profit here, our break even. This is the break even here as well. It's actually plotted on this chart with the blue line here. Maybe I wouldn't go as far as say max loss and max profit. These are sort of overall for the trade overall, but I do sort of consider that this is our max loss at expiration, because we can only achieve our max loss on this spread at expiration. You'll see when we actually manipulate this diagram that it's going to be impossible to achieve 100% max loss anytime prior to expiration, and same on max profit, right? So that's our max profit at expiration. It is our max profit overall, but we won't have that opportunity to collect that entire premium without holding this to expiration, I guess is what I'm trying to say. Based on the trade dynamics, I mean, ruling out any sort of weird pricing, or you're able to exit the trade with some weird price, or again, not counting legging out or doing anything that would manipulate the price of that of these options. Okay, so again, all those values are at expiration. The chart is at expiration. And I think that's maybe where a lot of people go wrong. So for a for a beginner trader, they're sort of looking at this and they're saying, wow, look at my break even, I can make profit here. With really just a small move upwards, I'm going to be at my max profit, right? And even a little bit of a move down, I'm still going to be, as long as I'm above my break even, I should be profitable. And obviously, if I exceed my break even, then that's going to be where I'm going to be, encountering losses, right? So that we have some reference points on this diagram that we're using to determine, and it's all occurring, right, really in a very narrow place on this diagram, right? We're just seeing that everything all those reference points all kind of sit here, right? Maybe this other one. So there's another reference point, which is our long strike, right? So where we hit our max loss, where we hit our max profit, and our break even, right? So 3 reference points that are all kind of very closely situated in this case. So that can lead to some confusion, because people think that diagram is an accurate representation of their trade. It is an accurate representation of their trade held to expiration. So all of the things, even the shading here, the actual green versus the red, that's showing us our kind of risk reward. So roughly for every, for the size of the green box, we probably have maybe twice, maybe 2.5 times that of red. So we kind of know our risk reward here. But again, that's all at expiration, right? And again, it looks like we can achieve our max profit with a very small move in direction. And what we'll see, actually, that's probably not necessarily a reality. So the benefit of this tool is it's allowing us to view other dimensions. So what's another dimension? Obviously, the time is going to be another important dimension to analyze. So we know we can benefit from direction in this trade. We also can take advantage of time decay. So that can be a positive for us in a credit spread like this. And most people are aware that a credit spread where we're selling options is going to benefit from time decay. But that's totally dependent on how we set the trade up. So where we set your strikes here is going to be an influence on how much of an influence that time decay will have as well. Okay, so this is how the tool works. We're able to actually manipulate this diagram and actually show our current P&L curve. So this is, again, 28 days to expiration. We're putting a new trade on. Our break even currently right now is going to be right where the underlying is trading at, right? So it's at 50.48. Okay, so we know that's, again, confirming our break even at expiration and our break even today are 2 different things, right? And very easy to understand this one. Obviously, we just put the trade on. Nothing else has moved, so that is our break even, right? Any move up or down, any move up, we should have a profit. Any move down, we should have a loss, or independent of any other factor that changes. But is it actually going to work that way, right? What happens after some time decay? Is that now our constant break even? No, our break even is actually going to move, right? And you can see this is a bit of an oddball one. Look, our break even is actually moving away from us. So we've moved quite significantly here. I don't know if you noticed that, but I'm now at, say, 11 days in the trade. So I've still got 17 days to remaining, but I'm kind of, held this trade for a fairly significant amount of time, but now my break even has actually moved against me. Okay, and you'll see that. You may notice with a lot of your positions that they're losing money in the first few days, and it takes them a while, particularly on a longer trade like this, to sort of all of a sudden that time decay starts to kick in. It takes a while for it to kick in. And in this case, it's actually working against us, right? And you would say, well, I thought on credit spreads, time decay is in our favor. It's not when we're very close at the money like this. So we've got a short strike here is at a 45 delta, and we've got a long strike is at a 40 delta. So at the money and a very near at the money. And again, these two strikes work kind of against each other, right? So the short strike, time decay will benefit that position. The long strike, time decay will not benefit. So depending on where those strikes are set, it is going to have an impact on how quickly this trade responds to time decay. So if you just watch the right-hand side, just watch the green bar, watch as it moves up in value. So it should move up and start to conform more to that line at expiration. So I'm just going to move it to the right, and I'm going to move fairly quickly. And you can see, I mean, maybe I moved it too quickly, but the line is actually moving very, very slowly here over to the right. This right side of the diagram is moving upwards very slowly, not until you get very close to expiration, then all of a sudden it's moving kind of up and to the left because it's got to fill this empty part of the box over here, right? And now let's look at the left side. Let's look at what's happening on the left side. So the right side is our profit side. The left side is our loss side. So the left side, as time decays, as time goes on, our losses are increasing. And again, sort of the speed of their increase kind of ramps up very, very, very close to expiration. So the time decay is only a benefit when we are when the underlying price is kind of to the right, right? It's above us, so we're out of the money. So if these strikes, as they're out of the money, then we're going to benefit from time decay. Once they're in the money, and clearly the deeper they go in the money, the more time decay is going to work against us. So that's something definitely to keep in mind, that not all credit spreads work the same. And that's the power of this diagram. We can use this to sort of set our profit targets. This, from the very far right here, so this is if this S&P 500 index is trading around 50-50, right? That's our kind of short strike there right at the money. Maybe we move up to, say, 51.50, somewhere about here. That's like a 2% move, and then maybe another 200 points or so. 52.50 is going to be, it looks like about a 4% move, and that's the range here that's been input here. It says 4%. So it's basically drawn this diagram with a kind of a scale here, plus or minus 4%. So if we're expecting a larger move in the S&P 500, we could kind of zoom out, and then we could see with a larger move, yes, we're going to get closer to that max profit. But again, our current risk diagram here is very different, right? Yes, the risk reward is that, maybe slightly lower than 2.5 to 1 here, $2.50 of risk for every dollar. But it's only really at expiration, or really far out if you have just a really huge move, right? If we zoom in and let's say we're going to expect a much smaller move, we can see here, I mean, with just, if we're expecting maybe, say, a plus or minus 1 move, we've got a loss here on the downside of about $300, $290, and we've got about $250 on the upside. So it's fair to say that depending on how you're planning your trade and how much move you're expecting in price, and how much time you're actually going to be in the trade, watch this as it goes over time, right? So if we're only going to hold to, say, 10 days, so that's 13 days. Okay, say we're going to hold for till 11 days, and that's still 17 days remaining. Um, and let's say over those 10 days, we're expecting maybe a larger move or so. But we can still kind of predict, we're getting very close to our max profit, but we're not really getting very close to our max loss. So we can use this to kind of, reevaluate that risk reward and what's appropriate for us, right? That max loss is really only really relevant if you're going to hold it to expiration, right? So, or you're going to have just some crazy outlier move, and the stock's going to, move totally against you, right? So it has a certain meaning and purpose, but for the purpose of things like setting stop loss or setting profit targets, these max profit and max loss, again, they're at expiration. They may not be relevant to you and to your particular trade setup. So let's just kind of put this back to the original Zoom here. So that's how the risk graph works, and we can see again that fact here that our break even's kind of going against us here. It's not really. That break even is actually moving, right? It's going against us, right? So it's not until very close to expiration that we can really, profit from this trade without actually having a directional move. So this is, and again, I've picked bull put spread, and this must just be the default. It thinks that okay, you want a bullish trade, so it's basically modeled a very bullish trade for me. If I want to do more of a kind of a traditional setup, again, for somebody that's wants a more high probability trade. So here's, we're at a 30 delta for 49.75, 49.50. So same strike width. So risk reward is different now. So now at expiration, here's what it looks like. So that might be, I don't know, I'm just guessing, maybe like 5-1 or something. Yeah, maybe 4-1, I'm guessing. Yeah, 4-1, 500 to 2,000. Yeah. Again, now we've changed our risk reward, but we've also changed our risk profile completely, right? So how it's going to even react to time decay is going to be very different. Watch this one. It's immediately moving down where we're getting, now our price doesn't need to move. Just time decay is acting immediately. It doesn't have the effect. Again, we've got a long and a short option. They're out of the money, so we're actually benefiting from time decay on this particular setup. And you can see as I move to the right, it's actually, reacting more consistently and quicker regard to time decay. So this is a better trade setup if you want to have a more high probability trade, obviously, because we've got, we're sort of deeper out of the money here. We've got the opposite of that is we've got a worse risk reward. But we can, for a shorter amount of time in this trade, so for say 11 days in trade, you could see it's going to be much easier for us to get our profit target. We don't need, well, we still need, about a 1.2% move in SPY. What was the other one? To hit our 50% profit target, we need about a 1.5% move, or 1.5, 1.6, somewhere in there. So I'm just trying to eyeball it to see that. So again, where you set it up, this is a more bullish trade. It needs a more stronger move in your direction. So there's I think a lesson in there is not all credit spreads are the same. They don't react to different factors the same way. We've identified a couple of factors, right? So time being one and price being the other one. And how your spread will react to either of those will depend on your the way you set up your trade. Implied volatility is the other, and it's again going to work very similar to what we saw with the time decay. We just move the slider. We can demonstrate a reduction in implied volatility, which will benefit this trade. It's going to improve our profit and actually worsen our losses on the left, right? So as we move up with an increase in implied volatility, then our profits decrease, but our losses also decrease. So again, it works differently depending on the side of the diagram that you're on. Something to just be aware of. Maybe I'll just show a credit spread. A iron condor. Just going to go back to the home page and pick iron condor. I'll do the same thing. Just let's see what it presents here. And this is looks like a fairly narrow iron condor. Very, again, it seems to be favoring these very high reward, low risk trades. Let's see what this one tells us. So we can see we're very skewed here. So we've got a break even very close to us on the downside. So again, everyone should be familiar with this diagram. Actually, I probably should have started here. This is the diagram at expiration. So we have two break-evens, right? We have a break-even to the upside and a break-even to the downside. So again, everything you see on this diagram is at expiration, and including those break-evens. And we're going to see some funkiness here as well. That as the trade stands right now, there must be some, a significant amount of call skew, meaning the value of the calls are much more more in demand, therefore higher priced calls versus the puts. I mean, we could just kind of look at our short strikes. Price is 49.50, and that's a delta of 40, and we're at a delta of 50, and we've got a $94. So I don't know why it's set it this way. Maybe if we let's move it out, something like that. I think we're still $25 wide, right? Yeah. Again, I don't know what logic it's using, so that's a 40 and a 45. Maybe moving another one out. Probably messing it all up here. 40 without changing it. Okay, so we're both at a 40 delta and we're $25 wide. So again, even iron car, still a pretty high, low risk, high reward type trade. And we can see our P&L at expiration. So now we're skewed right to one side here. So the current price of our underlying is way to the left side. So we're really close to that break even. Yeah. Anyway, so anyway, we just really want to just highlight that the same thing applies here, but again, our break evens are going to look very different than they do at expiration. So certainly, if you're looking at iron condor, and maybe we ignore the fact that we're not centered here, but we've got a break even and up, and it's sort of equidistance. Both sides look identical, but prior to expiration, we can see that. I guess it's pretty equal. Maybe in the beginning of the trade, if it's going to be very hard to profit on this trade. You get really no opportunity to profit even just a couple of days in. Let's do that same thing. We're going to go to 11 days in trade. So we can see here. This is our our P&L graph, right? That it's charted. You can see how small of a reward we could potentially get here. So our max profit as of 11 days into the trade is just a fraction, right? It looks like it's even less than 10%, right? So if we wanted that same sort of trade duration, we wanted to sort of target exiting the trade in about 11 days. Unlike the directional credit spread, where we can plan for 11 days, but we're expecting a certain directional move. Here, directional move is going to hurt us, so it needs to stay the same, and there's just no possible way that we could profit from this trade, right? There's in that short amount of time, other than maybe we set a 10% profit target might be appropriate or something for this trade. So again, not all profit targets are appropriate for all trades. Even as let's say a 25%. Going to be at about $500, somewhere right there. Yeah. So to get 25%, we're going to need to really hold it for 21 days, roughly, close to 7 days remaining. So here, it's telling me that this sort of trade setup, probably 10% profit target, maybe, kind of on the low side, and maybe on the highest you'd really expect would be maybe 25%. The only time that it really looks anything like this diagram at expiration is probably that day of expiration. So at 0 DTE is the only time that it's really actually going to look at that, right? This is 10 hours remaining. So that's I don't know how accurate this is. I think it's trying to show you some smaller increments other than just daily increments, but 5 hours would be, basically at the market open, I guess. So, it kind of just shows you, I think I saw someone asking a question like, um, my position, I've got a 95% profit target on an condor and it's not closing. Why is that? Well, yeah, look, you might as well just hold it all the way to expiration because, the only chance that you're really going to get within that range is, again, holding it very, very, very close to expiration. And you still need to be right in the middle of that, between those short strikes, right, centered between there. So notice how, currently we're centered off to the left here somewhere, but as we go to expiration, already our center is probably somewhere here, the highest point on that P&L curve. And now it's sort of starting to kind of conform closer to this center point. Yeah. So yeah, so that's again important. This is what it looks like at expiration. Here's what it looks like around 7 days to expiration. Nothing, it doesn't look anything like this trade. So you're thinking, wow, look at this max profit. Wow, I can get that max profit. No, that is the max profit at expiration. It's not an achievable profit, and this is probably a very low probability trade, right? Just based on the risk reward, I know that this isn't the paid version, so I can't see what it's saying for the probability of profit at expiration, but I'm expecting this is probably a pretty low one. Most likely it's going to be, out here somewhere. So, if you set your profit target successfully, so, here, if we set maybe at 5 days remaining, if we had a 10% profit target, we got a much wider range of where we could still, achieve profits. We still, again, need to hold it all the way to 5 days to expiration to have that kind of wide of a range. But that's iron condors and credit spreads, and that is how you use a risk graph to analyze your trade. Do it at trade setup, and what I didn't show, but you can kind of figure it out, is how to input your prices. So if you just set this up, so let's say this is a trade that you're in, you put in your fill prices in here, and it will show your current P&L regardless of when you enter that trade. So a useful tool for monitoring positions as well, and then you can exactly see what happens, and you can see, where am I now? If I'm off here to the left somewhere, then you can see, what's going to happen in the future. Well, if I stay out here, I'm just going to do nothing but lose from here. I need to, and if I'm out here, as time is going on, this risk profile is compressing, right? So it's compressing to conform to this one at expiration. So even though I might be here, to the left, and I'm still close to, I'm not far, don't have much of a loss. The only way I have a chance to profit is if the price moves up, right? If the price increases. So that's the lesson in using OptionStrat or any tool like OptionStrat that lets you model a trade and view the impacts of different factors that affect your trade. Things like price of the underlying, time in trade, and implied volatility. Those are the three main ones. All three can be manipulated using this tool and other tools like it. So I encourage you to learn more about how to interact with your trades. It's definitely this is the part of learning with options trading, and again, it takes years of understanding to kind of know what makes a trade work the way that it does. But without a tool like this, you're not going to be able to even come to that understanding. If you only see this view and you haven't actually seen this interim view, if this is new to you, then you've got some learning to do. You need to really make sure that you get access to a tool like this and you do some experimentation.